And that leads to the biggest mistake that trips up Australians specifically at this stage. It's called asset concentration, and almost nobody hears this term until it's already cost them money. Here's what it looks like in real life. Someone builds their first $250,000, mostly through their super fund, plus maybe some shares in one or two ASX companies they felt confident about, often in banking or mining, because those are the names everyone knows. It feels smart because those companies are familiar and stable, but familiar is not the same as diversified. If a large portion of your wealth sits in a small number of Australian companies, all exposed to similar economic forces like interest rates, commodity prices, or domestic consumer spending, then a downturn in one sector can hit your entire portfolio at once. Advisors see this constantly with people who reach $250,000, primarily through employer shares or a couple of familiar blue-chip stocks. The solution isn't complicated, but it does require a mindset shift. This is usually the stage where broader diversification, including international exposure through global index funds, starts to matter far more than it did when your balance was smaller. Spreading risk across different countries, industries, and asset types protects the wealth you've already built, while still allowing it to keep growing. Now here's an advanced insight that separates people who plateau from people who keep climbing. At $250,000, tax efficiency starts to matter in a real way. Early on, a few $100s in extra tax paid on investment earnings barely registers. But at this level, structuring your investments properly, understanding how capital gains tax works if you eventually sell shares outside super, and making full use of concessional superannuation contributions where it makes sense for your situation can meaningfully change how fast your wealth grows. This is not about aggressive tax avoidance schemes, it's about simple, legal structuring that many Australians simply never get around to organizing, because when their balance was smaller, it didn't feel urgent. At $250,000, it becomes urgent. Here's a bonus tip that surprisingly few people apply. Once you hit this milestone, it's worth reviewing your insurance situation. This sounds unrelated to investing, but think about it logically. You have spent years building this asset base. If an unexpected illness, injury, or loss of income forced you to withdraw a large portion of it early, you could undo years of compounding in a single event. People happily insure a car worth $30,000, yet leave $250,000 of life savings completely exposed to the same kind of bad luck. A proper income protection or life insurance review, often available cheaply through your existing super fund, is one of the most overlooked steps at this stage. Let's talk about the future outlook now, because this matters more than most finance content admits. Interest rates in Australia will keep moving in cycles, the way they always have. Inflation will ease and rise again over time, the way it always has. Property prices in major cities will keep frustrating first home buyers, and market corrections will happen, because they always do, roughly every several years throughout history. None of this should scare you. In fact, understanding this is what protects your $250,000 from panic decisions. The investors who built serious wealth over the last few decades in Australia are not the ones who predicted every downturn. They're the ones who accepted that downturns are simply part of the process, kept contributing steadily, and let time do what time does. There's another reason nobody talks about enough. Once you cross $250,000, your biggest threat usually isn't a market crash. It's lifestyle creep combined with impatience. Wanting the next milestone too quickly leads people into risky speculative investments they don't fully understand, chasing higher returns because the slow, steady approach that got them here suddenly feels boring. This is exactly how people lose 5- and 6-figure sums in volatile assets, right after finally reaching a position of real financial strength. So what should you actually do differently from here? First, separate your money by purpose, short-term buffer, medium-term goals, and long-term growth, and treat each one with its own strategy. Second, check your investments for concentration risk and diversify if too much sits in one sector or one country. Third, take superannuation contribution strategies seriously, because at this balance level, the tax advantages compound just like your investments do. Fourth, protect what you've built with appropriate insurance, so one bad event can't erase years of progress.